I'm super excited today to be doing a shallow dive on BAC, Bank of America. And this is a shallow dive, so please put your glasses away, these glasses, and grab these glasses full of some kind of drink that you can sit back and enjoy this with. There is some value to be found, so stick around, I'll show you why. I'm going to be rating this on a very, very professional kitten scale, where I take a bunch of things that I think are important about the company and I rate them in the approval cats, bored kitty, or sourpuss category, which is a very, they're all very scientific terms. Now, I will be using stockanalysis.com for all of my data. This is not a highly edited video, so please just sit back, stop getting upset, or just click to another highly edited video. I'm going into the financials first because that is the very, very first thing we're going to look at to find out and ask the question, is this stock a buy? I am looking at a quarterly term because it gives me a little bit of higher definition of what's going on in the company. But as you can see, this thing is a complete snooze fest. Nothing's changed in a decade. It still receives the same revenue numbers as it did in 2012. That's kind of bad news considering inflation, right? So this, we can't be paying more than 10 PE for this right off the bat just because of stagnant revenue, okay? This is not a growth company at all. In fact, the banking business has been very entrenched. It's very tied in with the government through the Federal Reserve. It's a member bank of the Federal Reserve, Bank of America is. And so, it's extremely highly regulated. It's hard for them to do something to grab market share, although I might talk about that in the future in a little bit. Now, judging on revenue, it's a complete, I'm already bored. So I'm just going to go here and do a bored kitty for the revenue trend, that's for sure. All right, next is the earnings trend. So earnings trend, let's go all the way here to net income. We can see the earnings trend is actually up. So for somehow they're able to capture more of the money that's coming through their system. So that's it's not that exciting though, especially in the last 5 quarters. It's been steadily decreasing since the very inflationary period of the 2020 and early 2021. So that's not that exciting, but it's pretty steady. I would say it's reliable. I can only see a couple of negative quarters here in the past in 2013. Other than that, the company's been making money on every single quarter. So it's not quite, approval cats worthy. I want to put another board kitty here for the earnings trend. Next is dividend payout and ratio. Dividends and payout ratio, excuse me. So dividend per share, it looks like they've been raising dividends since 2013 pretty regularly, about every year or 2 years. So that's good. I mean, they're making money in their stagnant company. They should be returning money to capital. I mean, that's kind of what you do if you're not a growth company, okay? You return money to capital. That's it. If you're established, you've reached your peak, you're not going to grow, why should an investor buy your company, right? So there we go. Dividends increasing. So that's great. In fact, we can go to the dividend tab and take a closer look at this. The annual dividend right now is 85 cents per share. The dividend yield is 2.62%, which is below inflation, mind you. And maybe on par, a little bit above the par of the S&P 500. Payout ratio is 26, which is very healthy. And dividend growth is 13.33%. So that's all right. There's a little bit of a dividend history if you want to scroll through it and find out what's going on. There's dividend chart all the way back to 2013, and dividend growth has been very, low, maybe like 4.76% per year. So that's that with the dividend. I would say they're doing a good job of returning money to capital. It's what they should be doing when you are a well-established company with steady earnings. So I'm gonna give that. I have to give that a approval cats rating here. So I'm gonna give it to the approval cats. Very good. 2 board kitties, 1 approval cat. Now, fourth on the list is the share buyback trend. This is gonna be interesting. I'm gonna go into the financials. Make sure that we're sticking on the quarterly look. And going into shares outstanding, basic and diluted. It looks like they're buying back shares, which is what a value company like Bank of America should be doing. It looks like since 2017, they've erased about 20% of their share count. That means if you held 1% of the company back then, you're now holding 1.2% of the company. So that is definitely a plus. It's not super exciting, but I'm going to have to give it the approval cats. So that's 2 approval cats for Bank of America. We're getting closer to a conclusion here. Cash on hand. Oh, this is the 5th criteria here. Let's see actually what their balance sheet looks like. So I'm going to go to statistics, and we're going to scroll down all the way to the balance sheet. See that net cash position is negative $30.6 billion. Now that's actually quite a bit considering that their market cap is 261, but it's not that much for a bank. Investment banks tend to actually go in debt quite a bit more, and but they make good use of that capital. I'm not sure, since it's not necessarily an investment bank, what they do with their capital. I mean, they're paying dividends and increasing the dividends, but it's coming out of the debt. So it really depends how much interest they're paying on that debt, to figure out that debt is healthy or not. It's not overwhelmingly unhealthy though, as a percentage. So quite frankly, it's quite boring. So we're gonna put it into the bored kitty category here. All right, next on the list is price to earnings ratio. So the price to earnings ratio is 10.16, which is about in line of what it should be. I guess this is a tough one. I'm gonna have to give it the approval rating. Next on the list is enterprise value to earnings. So EV to E, that is at 10.998. I mean, yeah, okay. Approval cat. It's not bad. I mean, I've seen banks trade at 5 Ps in EVs to E, but with considerable more political risk, I think Bank of America is one of the most established banks out there in the most established jurisdiction ever. So we're gonna have to give them that premium. So 11 enterprise value to earnings is not horrible. All right, next on the list is enterprise value to free cash flow. Well, this should be interesting. So EV to FCF is 73.55, which is way too high. I'm gonna have to give that a sourpuss rating of 1. What's going on here? Oh, I see what's going on. Okay, so that's sourpuss rating. That's a strike. That's not good. It's way too high. But I guess they can afford it because their income stream is so predictable. But still, I don't like to see that. Next on the list is going to be profit margin. Now the profit margin is 29.28%, which is really, really high. I mean, they are kind of a services industry, so it's to be expected. But let's see what the trend says, all right? I'm going to go in the profit margin trend here. Oh, let's go to the quarterly. Profit margin trend. It looks like it's fairly stable. It's 32.7, it says, for the latest quarter. So I'm going to say that's actually pretty exciting. I mean, they're able to keep the margins high, and looks like they had some trouble in 2012 and 2013, but now they've swum out of it. They've remained fairly reliable when it comes to the margins in the last 8 years. I'm going to give them a approval cats rating. Profit margin trend, kind of boring. It's not increasing. It's pretty stable. And then finally, the story. The story for Bank of America. I mean, what's the story? The story is, they're a bank that's very tied with the government, super highly controlled. They have a fairly limited amount of moves that they can do. They're not innovating too much. In fact, I think Wells Fargo is kind of like the most innovative bank out of the big ones out there. No, I don't see any like drama or anything like that. Like no one's really making moves in the company. The big story, I guess, with the banks is the interest rates, and so they're going to have to do some shifting, and we're yet to see how they shift the way they do business to adjust for the sharp increase in rates. Traditionally, it's been okay for banks in the past, but it also increases their risk of like defaults and things like that. So the banks could take a lot of losses, especially in like consumer debt. Especially with all the credit cards that have been racked up in the last like 6 months, all the credit card debt and consumer debt, and that could come home to roost. So they could be experiencing some temporary heavy losses. So even though they're collecting more interest, the default rates should be increasing if they haven't already. So it's kind of a neutral bag there. I want to say that the story for this company is quite boring. It's a little bit of a yawn fest. So I'm going to put that a 5. So overall, we have 5 approval kitties, 5 board kitties, and 1 sourpuss. I think looking at the valuation of the company, I think that quite frankly, it's a little bit too expensive. I think the market cap 261. Making, what is it? Let's go back to the financials. Quarterly net income, making 20 billion a year, for a 261 billion market cap company, it's quite rich. That PE is going to be dropping once these, 8 billion quarter earnings are in the rearview mirror. So I think the PE is actually going to increase, which means that the company is not a buy yet. I would say not 200 billion, but this bank probably could be bought at like 180 billion. So I'd be looking personally for a price action of, let's see, the last 5 years. It's traded as high as 49, currently it's 32. I would have to probably see it in the low 20s if I were to consider this bank a buy, all else being equal. So that's the final verdict. It's not too exciting of a company, doesn't excite too many kitties. So if you own it, hold it if you want to, but I wouldn't personally buy it unless it's in the low 20s. That's my conclusion. Agree, disagree, let me know in the comments. Peace out.